Hi, everyone, and welcome to this episode of Crushing Land. Happy to be with you today, and we are going to be talking about the profit potential inside of a deal and how to properly focus on that based on basically the size of the deal is what it comes down to, and also your expectations, your needs, and things like that. And so anybody that has listened to me for a while, followed me, gone to any of the events that we've done or anything like that, you've heard me talk about different things inside of the deal, focusing on your return on investment, talking about making money on the ratio in the deal, and also making money on the spread in the deal. And so what we're going to do today is we're going to break that down a little bit for you so that you can get some help with that in moving forward. And so when it comes to real estate, what happens very often is that people focus on ROI, which means return on investment, right? They're focusing on basically what their money is bringing back to them, what they invested and what their return on that. So what does ROI even mean for those of you that's brand new to you? You've probably heard the term, right? You've heard return on investment or ROI, but what does that actually mean? So basically, what you're doing when you're figuring out ROI is you are taking the amount of money that you put into the deal and you are subtracting that amount of money from what you sell the deal for or the amount that you receive at the end that you receive back. And so you're taking that amount and you're subtracting it from what you're getting back. So you're taking what you made, you're subtracting what you put in. That leaves you with a new number. You then take that new number, whatever that spread is, and you divide it by the initial investment, right? And then you multiply that by 100, and that gives you a percentage. It gives you your return on investment. So let me give you a little bit of math here that can help you with this and also help you to see that return on investment, while important, is not necessarily the most important thing. And it can be a little bit deceiving. And so what we're going to do is we're going to help you see that through some different real world examples of deals that we've done that can help you to understand exactly what this means. So again, I'm going to give you a real world example here of one that I did and to help you see that how ROI is important, but at the same time can be a little bit deceiving. So we did a deal that we purchased for $500, and we are now selling that deal for $9,000. So you take the math that I mentioned early on, you take that $9,000 and you subtract 500. What does that leave you with? $8,500, right? Now you take 8,500 and you divide by the amount that you originally put in. 500, right? So I made $8,500 by putting in 500. That leaves me with the number 17. 8,500 divided by 500 is 17. Multiply that by 100, and that leaves me with a 1,700% return on investment. And that sounds amazing. That is great. Don't get me wrong. That is a great return on investment. But let me show you why that number is not necessarily the most important thing. Keep that number in mind, right? 1,700% return on investment. I did another deal. I bought that deal for $5,000. Okay. We then sold that property for $75,000. So again, do the same math. 75,000 minus 5,000, you're left with 70,000, right? 70,000 divided by the 5,000 initial investment leaves me with 14. 70,000 divided by 5,000 is 14. 14 times 100 is a 1,400% return on investment. So when we look at it only from the perspective of return on investment, the first one was better, right? That was the better deal. I made $8,500. I had a higher return on investment. But on the second one, I made $70,000 with a lower return on investment. Which one's better, right? I don't know about you, but I would all day long take $70,000 over $8,500, regardless of the return on investment. So sometimes we get so hung up on that number that we're not really looking at the big picture. And the other way to look at it too is that the math can be deceiving even across the board, right? I bought a property, like I said, I bought it for 500. I sold it for 9,000. So again, the same numbers, right? 500 to 9,000, $8,500 in profit. 8,500 divided by 500 is 17. So again, that's 1,700% return on investment, and that's great. That's a great deal. Don't get me wrong, right? Making $8,500 profit on $500 invested, that's huge. But what if I remove a zero from both sides? So now I'm buying for $50 and I'm selling for $900. Guess what? It's the exact same return on investment. Okay? Let's remove another zero. Buy it for $5. Buy something for $5 and sell it for $90. The exact same return on investment. Now let's go the other way. Let's add a zero to what I talked about. Buy it for $5,000 and sell it for $90,000. The exact same return on investment. So if you're looking only at return on investment, every one of those is 1,700%. But which is better? Are you happy buying something for 5 to make 85? Well, sure, right? But I ain't got to pay bills, right? 5 to 85. What about 50 to 850? That's better, right? Same exact return on investment, but obviously it's better. My actual deal, buying for 500 and selling for 8,500. Again, better. And then finally, buying it for $5,000 and selling it and making $85,000. Exact same return on investment in all four of those cases, but which is better, right? So again, don't get so hung up on just the return on investment number that you're forgetting about the big picture. So the focus should really be on the profits, not the return on investment. And where the return on investment is much more important is on the lower end deals, like the example that I just gave you. And one of the things that we talk about when we teach this is we call it making money on the ratio, meaning you want to have a better ratio than you do in other cases. So for example, in that case right there, I made 17 times my money. That's a very good ratio. Even if I buy for 1,000 and I sell for 7 or 8,000, right? That's 7-8 times my money. It's a very good ratio. On higher end deals, we talk about making money on the spread. And the spread is the difference between what you buy it for and what you sell it for, not being worried about what your percentage is. So again, let me help you with this, and we're going to go back and use some real life examples to help you see the importance of looking at it this way. So we go back to that deal I bought, right? $5,000. Sold it for $75,000. Again, an amazing deal. 1,400% return on investment. And I made $70,000. It's a great deal all the way around. It's a good money maker. It's good profit. It's good return on investment. All of those things. Okay. Now let's look at a different deal. This was a deal I helped a student do. They were purchasing a property for $1.1 million and selling it for $1.4 million. So if you take out that 1.4 million, the sell price, and you subtract 1.1 million from it, that leaves you with $300,000. $300,000 minus the initial investment of the 1.1 million is only 0.27. 0.27 times 100, 27% return on investment. So the question is, again, if you're looking only at return on investment, would you rather make $70,000 with a 1,400% return on investment? Or would you rather have an ROI that's less than less than 2% of that number, right? At less than 2% of that number at 27%, and make $300,000, because that's the difference. So that's where you need to be looking at this from. Am I looking at it, the profit potential from only my return on investment? Am I looking at it only from doubling, tripling, or quadrupling my money? Or am I looking at it logistically on the spread? And in that case there, you're talking about $300,000, not a great return on investment, but an insane spread. Whereas in the $75,000 case, I made, a very good return on investment, but not as much money. And then in the in the $9,000 case, selling it for $9,000, it's even better return on investment. It's the best out of any of them, but it's also the lowest money maker. So the point of this was to give you guys some real world numbers to understand where to focus. And again, on larger deals, we focus on the spread. On the lower end deals, then we do focus on the ROI, or the ratio in that case, where you're seeing how many times you can make your money back. And so that's just a way that helps you to understand exactly how to look at these numbers and look at these deals to figure out what's best. Because a big thing in real estate, it's not so much in land, but a big thing in real estate in general is return on investment. And it's a way to calculate things and a way to figure out what investors are going to get and all of that. And I'm not saying it's not important in other forms of real estate, and I've been involved in all of them. It's very important. But in this here business, you're much more important. It's much more important to be focusing on the actual deal spread and the profits and where they stand. And again, that varies from person to person, even on lower end deals. So for example, some people when they're starting out, they just need to get an infusion of capital. They have a property under contract for $2,000. It's worth 10, but maybe they just want to get some money in, so they sell it for 6, right? They're only tripling their money. It's not a great return on investment. It's only $4,000, so it's not a great profit, but it's still profitable. It's a good deal, and it's helping them to get some money in the bank and get going to their next step, right? Whereas somebody else may sell that for a higher price. They may sell it with owner financing, all of these different things that change the numbers around. So again, just a kind of real world information here, real world numbers to help you to look at these things objectively. And as you could see from the examples there, sometimes the best moneymaker that you're going to get is not going to have a great return on investment. It's going to be very low return on investment, but the profits, the spread between the two numbers is huge because of where the numbers are. Whereas conversely, you may have deals that make you insane return on investments, just totally insane numbers, but yet the profits there, the actual dollars, well, good, are not enough to sustain a business, right? You have to keep doing them over and over and over and over again. So again, the biggest key takeaway on this is don't focus solely on return on investment. Focus more on return on investment or ratio on lower end deals. Focus on the spread on higher end deals. So if you have any questions on any of this, you can comment below. Obviously, reach out to us. Our information is below as well, and we break all of this down in our training as well. So you can reach out to us with any questions on that. So thank you again for tuning in this week for Crushing Land. We'll catch you next week with another related land investing topic.